Hello, welcome to Mark's Minute, once again recording in my home studio. Every year I get asked, what do I think about gold? My usual answer is not much. Gold is a traditional store of value, but is frequently a poor investment. It doesn't grow in value or pay a dividend in the way a company like Apple does. It doesn't pay interest like a bond or a bank account. In fact, it costs money to store. Warren Buffett famously said, gold gets dug out of the ground in Africa or someplace. Then we melt it down, dig another hole, bury it again, and pay people to stand around guarding it. It has no utility. Anyone watching from Mars would be scratching their head. My first gold purchase was the engagement ring from my wife. That worked out really well for me, so it's time to consider gold again. Our first investment in gold for our clients was this past June and again in January using a gold ETF symbol GLDM. Have we become gold bugs? No. Rather, it has to do with how we manage risk in portfolios. The primary source of return in our portfolios is from stocks, and likewise the source of most of the risk as well. We are planners and long-term investors. We understand that we experience challenging markets every 5 years or so. We recognize that an intellectual understanding of risk is very different from the actual experience of a ferocious bear market decline. So we help to reduce that risk by encouraging clients to hold other assets that will provide some stability when markets go south. Classically, that is high quality bonds, which tend to go up when stocks go down. Hopefully, there are no guarantees. The bonds provide some bounce up in the portfolio when stocks do poorly, thereby reducing the risk of the portfolio substantially. And the bonds pay a steady rate of interest. So while bonds won't generate nearly the return of stocks over time, you're getting paid to hold them. Unfortunately, the going forward return of bonds is always dependent on today's interest rate. Unlike stocks, bonds are fixed instruments with no growth. Interest is the only source of return for bonds. And since today's interest rates are so low, the going forward return from bonds will be low as well. This is where gold starts to shine. Gold tends to go up when stocks go down. And according to State Street Global Advisors, quote, during the last 14 equity market downturns, gold has provided an average return of plus 6.3%, while the S&P 500 index pulled back minus 21.5% on average. We replaced a small percentage of our bonds with gold, and it functions as a hedge or insurance. The cost of that insurance is the income lost from not owning those few bonds. Equally important, our clients get some peace of mind owning some gold, and hopefully that helps them stay invested as the markets gyrate and generate fear. And in an uncertain world, with a lot of clients retired or close to retired, a little bit of gold helping them sleep at night is a source of golden dreams. Thank you and good investing.